Go. I know, I'm a little late. All right, let's get this going. How are y'all doing today? All right. Okay, let me get some. Seems a little quiet in here. Need to get my my music going here. All right, cool, perfect. All right, let's get our Doomsday Front Center. Let's check it out. Am I at the right time? Yeah, we're good. We're good. Okay. Double checking the open in the market. I've got no no overnight trades and do anything. I didn't enter in anything new overnight. Good morning, guys. All right, hit that like button. Let's go. I feel like I'm looking a little red today. I think the camera reset. It has like a weird tone to it. Okay, let's go. FOMC date. Nothing will happen. Nothing will happen until a decision comes out. So really, just chill for a minute. We're gonna do some lessons, some chilling, some chatting. Click that like button while we're here. Good morning, friends. Let's go. Okay, rational. Market looks good. Everything looks tight. And this is not outside of one risk interval band. This is in the band. In the band, we're good. We'll do some. Let's load things out. Gotta restart that. Oh, I think I need to log in again. That's why. Okay, hold on. Oh, that's why. That would be why. Oh, I have to re-log in. So I got my, what is that? My Apple is still there? Okay. Pushed a couple new releases live last night. Here we go. Guess we gotta log out, log back in. Right. How you guys doing today? How's y'all's morning going? How's y'all's morning going? I had a great day yesterday. Great market week last week. Things have been killing it. I mean, like honestly, I had a 70K week. It was really nice. Yep. All right, let's go. BSU on the S&P. Let's check it out. What is this? Let me get my playbook. I had to reset my computer last night, so go straight to liquidity maps. Your first day here. Make sure you grab the Rocket Scooter free trial down the link in the bio. The description down below. It'll show you all the things. We're revamping our dashboard tonight. We have a lot of changes coming through the next couple of days on the platform, which is going to be good. BRSU, and it'll give you lots of, like, all this stuff will be, there's more training videos, everything's coming out. BRSU is a trade between blue and yellow on the S&P with resilience less than 0. The S&P could fall really far today, down to 370 possible. There's a liquidity pocket right here, so there's a trap inside of there for that BRSU and the S&P. Got Qs really quick. Good morning, guys. What's up? I feel like I look unusually red on the stream today. I need to go change my camera settings real quick. BRSU, same thing. It's a yellow to blue scalp. I might grab some Qs off the bottom on Hedger. So what you see, right, when FOMC comes out, it's very simple. When the news comes out, this is a freebie for you guys today. Remember, click that like button. If you get up to 50, I'll teach you my trick. FOMC. I'm gonna tell you exactly what I'm gonna do. I'm making a trade yet. Nothing yet. I'm gonna fidget with my camera settings. I'll make for you guys. Here's mine. Oh, that's fine. Get my settings on. This is gonna be really okay. So hang tight. Nothing's going on. Don't do anything yet. I gotta find something. Hold on. Nudes. I have a lot of nudes on my phone. My nightlife is an OnlyFans model. My camera settings. I took pictures of these one time. I wouldn't remember it, I would forget them. So good morning. Hey, here we go. Bam, bam, bam. Let's see how I look here. Brighter, okay. I really do this. I take pictures of my camera settings. This logic is really stupid. Reset. It was this October. Okay, that's good. That's less red. Okay. Got a little white balance up here. See this white balance. Ooh, yeah. Look at that. Look at that fancy stuff. Okay. Can't wait for my beard to grow back. I look hideous. I know. Okay, so doing nothing today until FOMC comes out right now. I will teach you guys my trick in just 2 seconds. Get a little better. Logitech just loves to randomly, if you guys have a Logitech webcam, it loves to just randomly go, well, we're gonna go ahead and like reset the camera at the most inopportune time. I was recording a podcast last night, the Trading Camp folks. Which, by the way, should be released tonight. I was interviewed for about an hour. It was pretty cool. Told my story. I got to talk about Rocket Scooter a little bit, where I came from, just chatting. It was fun. I've never done something like that before. To that magnitude, I've been on dozens of like podcasts, but to where the podcast was strictly about me, which is kind of cool. Never done that before, and get to sit there and chat about stuff. And then right before that happened, Logitech was like, well, we've decided to reset your Logitech drivers today. So reinstalling everything, and when you do, somehow it just hates the setting. Logitech, not that I'm hating on the company, but nothing they've ever made has ever had good software to come with it. Have you ever had a Logitech anything? When will the episode be released? Tonight. Absolutely tonight. Yeah, I'll go a little more handsomer. Best I can do without a beard. I mean, like I said, you guys, stop looking at my face. I wouldn't be surprised if you unsubscribed right now because I look hideous without a beard. I mean, I have that handsome like my dad doesn't have a beard. He looks pretty like this. I mean, we're not terrible looking folks in the family. You have a Logitech keyboard and mouse. They're nice. Like the hardware is so nice. The software's always been booty. You set your camera settings perfect so you look the same on the stream every day. I mean, I have a bunch of cameras too. I just wasn't trying to use my good cameras for the front shot. I'm using my good cameras. I'm gonna do a side shot thing once I get all this set up for next week. With a really nice camera. I got a Sony a6400 with a really nice 1635 lens for it, so I can actually do 2 different projects with it. I can do a really nice kind of side shot, will be like this, or be like me talking to you, like, "Hey guys, and welcome to the stream," and I'll be on like that side. And then I can have it where I can do zoom out. I'm going to do my computer build video actually. I didn't keep saying I'm going to do it, but I'm actually going to do it today. Now I have some time after FOMC. So I'm going to build my awesome PC. I have all next gen stuff. I'm building a computer that's, I'm going to build a video for a dual build computer. It's going to be the best trading computer you guys have ever seen. Not that I'm bragging or anything, but it's better than all y'all's computers. Better than everyone's computers. As a matter of fact, I think it's so good. I expect NASA to give me a call because they're gonna need me to help use its brain power to propel, you know, rockets in orbit. Let's see. Their webcam sucks. Yeah, they do. I have a Brio, which is the 4K one. I mean, it's not, the webcam's okay, but I mean, as far as a webcam, I mean, you can see like it's a little fuzzy on the green screen because I need to re-optimize all this nonsense. So, yeah. But anyways, I'll do it later. All right, FOMC. Let's talk about this today, right? Let's get through the thesis. Whenever the FOMC is raising rates, the stock market sells off. It's pretty common. They've been raising rates, and we initiated QT, or talking about QT like last year. People sold the market into the covering spree. Let's go through a little bit of the dynamics of the actual here. The financial juice. Everybody, let me show you some tricks. You guys want to know some tricks today? Hit that like button. I'll give you some tricks. Financial juice. This is your best resource as a trader. If you've never been the financial juice, go there. I love these guys. Buddies with them. They built this platform. It is a news aggregator. It is a Twitter style news feed that allows you to aggregate. It's a news aggregate, so it allows you to pick anything you want, and they scour the web and they slam it to one feed for you. It does not get any better than that. The better part is they algorithmically parse the news for breaking news. So red text comes through as bigger things. as Powell's talking, that red text is going to come up. And you see these need to know market risk. These are the bigger things. So they have an algorithm that derives, you know, again, I don't know their technology, likely keyword searches and scoring. So here you can even see that even us, I need to change the Rocket Scooter logo. Even we're a partner of this company. A partner in a way that like we don't get anything. We don't get anything from it. We just he put our thing on here. So anytime I stream live, it'll even show you on the financial news that we're live. Yeah. No official affiliation with them. We like to support really good tech. So anyone out there that's made like an amazing tech piece, tech algorithms, you know, you name it, anybody that's made something that's substantial that we think is great, we always like to vet and show off. So these are good. I'd never not have this open. So it'll go woo woo when a good alarm goes off. You know something's good to go and check it out. So today, economic calendar. I use the investing one just because I've used it since the beginning of time. Literally since the beginning of time. This used to be delivered to me by a Triceratops. That's how long I've been doing it. Okay, so if you get down to the bottom, you can see that you can see today. So we'll check. This is current time today. We're gonna have just a couple of, everything else is gonna be ignorable until we get to FOMC. Am I on the right day? Okay, so time zone. Let me do my real time zone here. And I know I need to save my settings again. So doing nothing for a little bit. I'm going to walk you guys through today's trade setups that I'm going to look for. And whenever the market does go into FOMC, y'all stay tuned. There's the trick, my special trick. Make sure you guys like that, like in the stream. Why are you watching UBXY? Always. VIX is basically, I'm just making sure that VIX is going to stay stable. Market's pulling back a little bit. Nothing happens until the decision. 13 o'clock today, when the decision comes out. So the market's just going to goof around. There are 3 steps. Three tricks. Going over my 3 tricks. Okay, you wanna know what they are? I'm gonna tell you something. I'm an expert at trading the FOMC. I'm already in the best trade I can be before the FOMC. You guys even see it. If you guys are just tuning in, you miss out on the best trade you can ever make the morning of FOMC. Did I look abnormally large on my screen? Let me show you guys what it is. Okay, ready? The best trade you can make before the FOMC. Are you writing this down? Is no trade. Is do absolutely nothing. Market will go nowhere and do nothing unless there's some leak. You're always going to be prepared, but even so, if something leaks out, the only thing that you know that it's a leak for the good side is that the market abnormally sells or abnormally rallies, right? So if the market's abnormally rallying into FOMC, I mean breaking risk intervals and going, you know something's leaked. If the market's crashing before FOMC in a bear market, that's the expected news, ignore it. So remember, when you're looking for a catalyst, the secret to trading is you always have to trade with it in your brain that somebody has inside information, right? The hypothesis of efficient market theory, what we call efficient market hypothesis, is that all available information is effectively traded in as soon as possible or in real time. So if the FOMC is raising rates, which you know they're going to do, probably 75 basis points, a cut to 50 would be a rally like you wouldn't believe, okay? The unemployment filings have gone up. That has rallied the market all 3 times. We know that that happens. That was my thesis to call a bottom. That was Daddy's 70K week last week. You guys remember? And Daddy is extremely bullish. I'm talking like ultra bullish, okay? So right now, just taking a look at anything, there's nothing going to move until, I think, nothing big on the indices are going to move until we get there. JP Morgan's still going. My expiration for that would have been last Friday, I believe. So if you guys remember, my JP Morgan trade was 1100% Y'all want to see him make a recap of that video of that trade. I'll have that published sometime today or tomorrow. But JP Morgan was just going crazy. I think I had 120 strike calls, and I got rid of them at the end of Friday. So today is what? Wednesday, Tuesday, Monday. So I closed them like here. So I was in that JP Morgan from the minute we had, I think it was CPI that reversed the market that day. Was it CPI? Still kind of remember. It was, I think it was, that was what flushed the market out. And then we turned around and reversed. That morning is when I jumped in that JP. Everybody's asking me like, when did you get JP? Nvidia's moving today really quick. No data here. Ooh. Is that us? Or is that little ghost us, or is that a trading view thing? They're always adding little cute little quirky features to the platform. Okay, so Nvidia's moving on a BLU. You pull the liquidity map on BLU. I'll show you what it looks like. A BLU is a support at hedge pressure that continues to go. If you trade above the opening price, it continues to move higher to whatever the next target is. Let's look at Nvidia just to see where those upper targets will be. We are rational today. Did you guys see what Doomsday says on the platform? Nvidia has a gap fill at 145, so that's a good target for today. So Nvidia's looking hella hot for today. Stocks like this, what I like to do is I like to not be in a position going to FOMC, especially not longing options. What I like to do is I like to let the market dip and return, and I'll take the long up a hedge pressure every time. I love opening above hedge pressure and opening above monthly. So Nvidia's having that look to it. Qs are having that look to it. You guys remember, I'm long Apple, I'm long Google. I'm about to want to be long some Tesla. I think I'm really loving this market. I like the idea that okay, so Tesla does look like it's still in that bear structure. Great. My watch list today is going to be Tesla, Nvidia, and I got Walmart on my list as well as dips to buy. These are my, don't ask me why, my specific thesis is spreading out into things that I think are the most damaged, or the things that I think actually have room to grow. I think the Walmart and Costco's and Targets of the world are gonna be looking great. I think everything else is gonna be kind of random. I think Amazon's kind of booty. While Google and Microsoft do look bad after earnings, I think that those are the place to take for the end of the year for a swing through. I'm getting December calls on those guys. The market dips and that IV crunches after we get the FOMC report. I'm gonna load up. Still holding Google? Oh yeah, absolutely. Absolutely holding Google still. Yeah. I have a monster-sized position in Google. I'm talking monster. Put about maybe 20 grand into it. Just Google alone. I've got my swings are just right now. I have Google. Oh, let me talk about my trades. Okay. I have Google, I have Apple, and I have just some QQQs. Everything is expiring the 9th of December, with the exception of some 25th of November's for Google. So Google, Qs, and Apple, these are just the swings I've been holding. Qs are something I was entering in yesterday, just a little bit. So basically, the way I trade FOMC is I get into a small position, because again, I'm paying a lot for it for the IV. But if we dip to an area that's of interest to me, I load up the farm. So when you're trading, right, so if you're trading options, it's hard to get in and out of options. The market's illiquid. Save your capital if you can, and you can trade futures. That's how I do it. I will trade futures every time. So you're gonna get a little slippage on everything you trade, especially if it's illiquid and out of the money. So if for instance, pretend that I'm trading Walmart, we dip to 140, and I want to buy those 140 zero-day calls. Or say, pretend it's a SPY, and you did some monthly, and I want to buy those 0-day right there. That's where you make a nice little day trade. Those 0-day Wednesday expiring calls. It's really quick. You can lose everything if you're wrong. The problem is when you dip and that volatility goes up, that spread gets higher and it's almost impossible to get in on them. So especially if market's dropping though, price of calls will drop, which is good, but the spread will be high. So you almost have to like market order to get into that thing right there. Or you can, if you have a little model, you can try to estimate what the price would be using the Black-Scholes. But in all honesty, it's really hard to get an option. So I like to trade futures. DD, absolutely, 100%. So we get that DD report coming through. Let's take a look at that. It was 0.64 on Rocket Scooter. Make sure everybody, if you've never touched the Rocket Scooter platform, go in there and give it a touch. Go to the Rocket Scooter website. It's a free trial, no credit card required. You can just sign up now. We have a free Discord. We're one of the largest Discords out there, one of the largest trading communities, period. The largest algorithmic trading community, the largest, one of the in Houston, Texas, in this little side of Houston, Texas, in this block that I live on, we're the largest trading community. Proud of yourselves. It's a 1 by 1 square mile radius, and we are number 1, maybe number 2. I'm so stupid sometimes. Why don't listen to me? 0.64. Okay, so what 0.64 means, it has a desire to hit the band. So I think what I like days like this is I love when days like this set up. You are rational going into Fed. That's great. So 2 things can happen, and I'm going to take a guess. FOMC comes out, okay? We are inside of here, and I don't bet that it becomes irrational, okay? I would love to dip here to there on whichever one of them moves the fastest. Does that make sense? Which one is the least scary of the 2, and how we determine which one's the least scary of the 2? Very simple. Come to your platform, go to indicators, and put both resiliences on there. This is a trick. Or we have them at the top. Whichever one is the least negative is the stronger of the 2. So today, the stronger of the 2 is going to be the S&P. If I'm looking to grab the dip, then I want the weaker of the 2. The weaker of the 2 is going to hit the bottom first. Aha, right? You guys see where I'm going with this? So today we are trading FOMC. One of the tricks is, now, despite me having a swing trade open, this is a very old swing trade I've been in, just a starter position on Apple. It's something I wouldn't be buying options going into FOMC because you're going to be paying a little bit extra for them because of the higher IV. Instead, I'm looking to get into the market trading something after the decision. Now, we know that per my thesis that bears have been covering their shorts when you've had unemployment filings tick up both times. So unemployment goes up and stock market has gone up. Why is that? Well, bad news is good news. And I was one of the, I guess, first people in the Twitter world posting my thesis on that. We've been talking about it since earlier in the year about how the market is staring just at the labor market and Powell's interpretation of the labor market, and such that his narrative really states that they're going to continue to be aggressive until, or they're going to continue their policy on the same path until they start to see problems that they cause. They don't want to induce a stagflation recession. So Powell's going to drive the boat as fast as he can until it's about to tump over, and he's going to slow down. So anytime the unemployment numbers filings are going up, the shorts start covering because they think that's the sign that Powell's probably going to taper hawkishness, right? A little bit less, maybe a rate hike of a 50 basis point or something. So until then, bad news is good news on labor market. We were one of the first to say that. That was my big thesis that got me long in all the stuff. We've been upticking that for a while, and I will show you those numbers. If you want to know where to find them, I'll give you that link. And again, make sure if you guys are here, click that like button real quick. Join our Discord if you haven't yet. Actually, wait, let me see. Let me do my Google. Initial claims. Jobless claims. What am I doing? Yeah, sorry. And this is the trick. These initial jobless claims here. You can see that I have a chart where it's showing you those moves. Anytime you start ticking up, the market has rallied along that path. Seasonal unemployment, but in general, people are getting laid off because companies are So there's two things, right? People are getting laid off because companies are trimming their fat. You know, the work at home still that aren't doing much, and the companies realizing they need to trim to ward off the recession. They're going to start, you know, either furloughing or laying off a couple people, plus seasonal unemployment, right? Going into the summer and of course beginning of the year after holidays. But as we've been seeing a general uptrend, the minute it started ticking up, that's in the beginning of October when this second data point I called officially a bottom for the year. As long as we don't start giving people their jobs back, Wall Street's going to be completely confident to short this. So if you've been shorting all year and you're a hedge fund, you've made all this money, and you see that the last 2 times this has done this, the market has rallied, you're going to lock in your profits at the end of the year. That's one of the things we're looking at. The second thing we're looking at is traders today. So this is my thesis setting up for the FOMC, right? Traders, very, very, very cool trick. I don't really share a lot of this with people too much, but in this group, I'm going to share part of it. Anytime this, if you look at the lines here, let me clear out the chart. Again, if you look at the yellow and not yellow, if you look at the green and blue lines here, I'll show you what the legend is so you can know. The green and blue are asset managers and leveraged funds in the S&P E-mini. This represents the risk of the stock market. Trust me on that. When green is going up, longs are becoming more long. When green is coming down, longs are selling. Blue is the net short of the market for the most part. When blue is going down, shorts are becoming more short. More people are shorting. When blue's coming up, shorts are covering. So anytime green and blue are pinching together or pulling apart, market's liquid. Liquid markets do not crash. This is the rule number 1 of trading. Liquid markets never crash. They can be bearish, but they don't crash. A crash is like COVID. A crash is like, I don't know, after Lehman Brothers goes belly up. Crash, to me, in my definition, is 3 red days of lower lows in a row, or longer, in a 5-day rolling period. Markets don't exhibit crashes without a catalyst while they're liquid. Never. They don't. When these are pulling away, they don't. Number 2 is the market has never crashed in the history of this report while the dealers are non-net negative, meaning the market makers are holding the bag as we've been selling it to them. They hold the bag. They're not going to lower the price on themselves while they're long the market. Simple as that. I mean, it's a very simple thesis. And while we've had those unemployment waves, there's the January one, which was this right here. And then there's the July to August one, which is there right there. So if you've seen the hedge funds that have been short all year, look at all these people short. Shorts are starting to lock in their profits already because they don't think the market's going to crash out. Now, I think the market's going to start to be worse if it gets worse. Remember, if it gets worse. Talking about summer of next year, Q2 earnings. He trades in QNES, just depends. He trade options and stocks and SPY and QQ futures. Is that correct? I trade options and stocks and futures, yes. Probably upside RA touch, absolutely. Is there a plan to plot the DD bands on the chart as well? Absolutely, yeah. Can I check out BABA? Okay. So let me look at that in just a second. When you start to see this blue and green line parallel with each other, trading down, the markets are illiquid. Illiquid markets tend to become more volatile. We've had that volatile stretch as the market was trading down. As bull markets continue, you start to see, normally in the middle of a bull market, people start to short that bull market, and that blue stays nice and steadily short. But you see at the end of the year, this blue getting higher and higher and higher and higher. We started talking QT way back in the summer of last year, but why did the market rally for 6 more months, even though there was bad news coming and rate hikes coming? Because everyone that was selling on that bad news, remember, back in July, everyone's dumping their shit to the market. There were enough people betting on round 2 of COVID because they were saying, well, there's going to be another pandemic, despite there being a vaccine, you know, whatever they decided to bet there, continued to short COVID going into the end of the year because it's flu season part 2. Right here, you can see shorts starting to build and holding, betting that there'd be another announcement of a shutdown. And there wasn't. So those shorts got squeezed all the way from basically March until February for an entire year. There was enough shorts covering at a massive loss as the shorts are becoming less short against the selling. So you had everybody panicking and dumping their shit to the market because of QT. But you had shorts like, oh my God, I'm so upside down because I shorted against COVID part 2. It didn't happen. So I got to get out of the loss. So You had people selling for profit and people covering at a loss, and the market was green and blue, right? Pinching like that. Extremely liquid. We warded off a market crash because QT should have collapsed the market, but Powell, cleverly dropped that in at a very liquid spot post-COVID. The timing was incredible, and the testament to the brilliance of Jay Powell, understanding the liquidity of the market when QT is a liquidity or an illiquidity induced recession, right? As the Fed is no longer printing money to prop up different markets, you can see they're removing their ability to provide liquidity. Well, we are providing it instead at the high. Very awesome how that was done. This is a case study for an economic textbook, right? So, neat thing. So right now, the blue and green are pulling away from each other, which means you have general buying. If you guys remember from my Twitter, everything I say is meaningful. I don't just make up stuff. The pinned tweet, we successfully called the July 2-month bottom. I pinned it for like 3 months. Everyone was talking about like that bottom and what happened in August, and it's going to turn back around. And we just nailed both sides of it, and I waited and waited and waited, and now I'm calling it again. I'm now calling a bottom for 2022 and a rally through mid-Jan. Genuine buying, not just short covering, genuine buying. There it is, the green becoming more green. You guys see it? Green, it's hard. Let me zoom in a little bit more. That green becoming more green, genuine buying. People starting to build a short for the next year. So genuine buying, people building a short. The blue is the weaker trade. You can stretch that chart out. Oh, yeah. I'll figure it out later. But you can see right here, people are becoming shorter faster than people are becoming long. So blue's the weaker trade. Dealers are holding a bag. They need to find buyers to unload to. The buyers are induced by the one with the higher slope. That interesting degree to use sometimes, the weaker trade are the people that are shorting the fastest, not the people that are longing the slowest. The buyers are very much not stepping in super quick right here because of the fundamentals. The people that are absolutely dunking that market short are easily scared out of their trade, as we saw last year. So if you're holding the bag, you need to squeeze out one side or attract buyers. To attract buyers to enter the market, which adds liquidity, you lower the price. To attract buyers to subtract liquidity or equal, we call it man for man, meaning that you remove your trade and they enter the trade. And an example, liquidity is two things. Number one is a buyer and seller next to each other, and number two is the number of participants in the market. And it's hard to measure the second one. In general, if I'm attracting a bunch of buyers and the sellers are the same amount, the market's more liquid. I'm attracting a bunch of sellers and the buyers the same amount, market's liquid. If I am in a trade and I start exiting my trade, then you're losing a man from the market. Like one person's leaving the game. If I'm exiting my trade while someone is covering their short, that's two people exiting their trade. So the market's becoming less liquid to a smaller degree than the market's becoming more liquid as people enter the trades. To a varying degree. So you have like a big push of liquidity, which is buyers and sellers finding each other. And then the smaller push is like the number of traders. So every time, so the FOMC is stepping away, you're losing a man, right? So do we gain a man on the playing field? We'll see. Are people stepping in buying? We don't know. So right now, as longs are becoming more long, we call it gaining a man. So like your team gets one more person. As people are becoming more short, you're gaining another man too. But it's 2 for 1. I mean, the slope is like twice as much almost. So you're gaining a bunch of shorts and gaining a bunch of longs. People are stepping into the market right here, longing and shorting it. So they're entering new positions. When people are selling and people are covering, you have people leaving the market, one on each side. You understand that? It's covering, getting out of a trade. So even though in general, when they pinch or pull from each other, the blue and greens, the market is very liquid. To compare the pulling against the pinching is less liquid than the pulling. The pulling is very liquid. Pulling means that they fan out. So the pulling is very liquid right now. Liquid markets don't crash. You have longs entering the market and shorts shorting the market. And look what the market does, right? In the middle of a bear market. When they're both parallel to the downside, when you have people selling, so you're losing a man, and people shorting, you're gaining a man. This is 1 for 1. So when they're parallel, it's like a 1 for 1. You lose a long, but you gain a short. Parallel is illiquid, and you're not really losing traders. You are losing a long but gaining a short. When they're both going, when blue and green are both going up, typically a short squeeze, you're losing a short and gaining a long. Short squeezes are the most, the stronger of all type of trading. You tend to have up, just green day after green day after green day when they're both pointing up. We haven't had them both pointing up in a very long time, not since pre-COVID. So it'd be nice to see us induce a short squeeze, because the dealers have never let the market find lower lows and collapse and start crashing until that red line itself is negative. Here's an example of that. Dealers are holding a bag as we dump to them after COVID. Right here, everybody's selling and shorting to the dealers, try to get ahead of COVID round 2. Dealers had the bag, and look, all that selling did not collapse the market, and they took a whole quarter, maybe 2 quarters, just to get rid of the bag. And as soon as the dealers are no longer long, you see how the market gets a little wider, more volatile, because they're not going to let that price drop while they're holding the inventory we dump to them. Same thing here. It's neat, right? The committed traders will tell you a story about the market, and the thesis is fantastic. Hit that like button. You guys like, we're dropping solid gold for you. Been waiting for the product. Oh, you're talking about for the can I put the COT chart in RS and make it as if it's a data point? I probably could. The COT is not actually released as a chart. I just love the bar chart, folks. I love to give them shouts as well, buddies with all the bar chart peeps. We actually, you can, the data is released to the CFTC website in a CSV file, I believe. So we can actually grab that CSV file. It's public data. You can just grab it and create an indicator. And create a COT indicator that's real-time interactive on our charts. Absolutely. Data point comes out once a week. So again, the thesis here, market is very liquid. You're gaining shorts faster than you're gaining longs, which means there are more people short the market than they're long the market week over week. You guys understand that? So if I'm a dealer holding the bag, I need to find buyers because I need to get out of my trade. I need to give it to one of you guys. Well, if I need to find a long, it looks like longs are stepping in at a rate fast and people are shorting. So if I need to find a long trader, I'm going to lower the price to attract a buyer. Or if I need to induce a long trader or induce a buyer by squeezing a short, I can raise the price faster. There's more people short that'll buy from me than there are people that are willing to take the risk to hold the bag for me. That makes sense? So short squeeze is a more prevalent environment, I guess, if that makes any sense. Does that make any sense to you guys? You have a lot of shorts all throughout here. Over the next 6 months, you have a higher probability that shorts will cover as opposed to longs buy. So people are not going to likely want to long this, and the people that have shorted all year have their opportunity now to take profit. If we flush after FOMC, don't find lower lows, it's another trade for me to get in on long. So I'm picking December. I'm aggressive, but I'm picking December expiries. And yeah, with doomsday greater than half, I'm expecting the upper band to at least touch once. The blue line is much greater than the green line. Does that mean the market as a whole is more bearish? No, I would say that when the market's bullish, shorts become more short. People are shorting against it. It's the difference between the two. You have to think of it as like the net sum is always zero. The people are longing the market, doesn't necessarily go up. People are shorting the market, doesn't necessarily go down. When the markets are going up, more and more people will be short. When markets are going down, eventually more and more people will be long, because that's what happens. So it's the difference between the long and short. So if more people are, it's like this, if the slope is like really high on the shorts and really flat on the longs, then the short has more people to that side of the trade. That's the offset to the dealer. The dealer's trading against the shorts more than they're trading against the long. The dealers need to get out of their trade. They need to squeeze the people that are trading against them, or else they're just handing out free money to the other side of the trade. That's how you read the commitment of traders. It's a storybook like that. You guys like that? Yeah. It's the trick. They'll need to close their position for in the year to take profits, so markets should go up soon. I didn't say markets should go up soon, but markets are more likely to go up than down in my thesis, unless we get a shock from the Fed. Those unemployment numbers, obviously we're going to get that reading tomorrow. That to me is more important than the rate decision. That's the controversial opinion in the room. But then again, I'm also known as a trader that's always a couple steps ahead, right? You guys were in the stream from September to October as I was screaming bad news is good news. I literally have a video titled Bad News is Good News. I was talking about that unemployment thing all year long. And people just tend to like listen to the talking heads, especially on Twitter and in the spaces and such. Everyone's just like repeating what you're normally used to hearing. On our end, it's more like we want to try to see something that we're ignoring all that noise, trying to see something other people don't see. Let's go. Made a couple new videos yesterday. We're essentially the videos we've been recording. We're releasing them. Okay, so the DD bands will be on the platform in about a week or two, maybe two, because we're actually releasing some new stuff today and tomorrow, some emergency releases. Just because we went and scoured the website, we're redesigning the website and the dashboard experience just to kind of make the customer experience a little better. So DD bands will be drawn on SPY only just to test, and we're actually working to get futures data and futures trading into the platform by the end of the year, which will segue into stock trading, options trading eventually as well. Well, futures is the easiest one to turn on. That's why we're going that route first. You think the morning, he said he trades options and stocks, but ESN and Q futures instead of SPY and QQ because liquidity. Yeah, I want to confirm you heard correctly. Yeah, you did. Absolutely. In volatile markets, I'm going to catch the swing. I'm just going to long futures. So S&P, my trade is literally this, right? I'm going to look for the S&P and other things to maintain and stay above monthly hedge. That's it. When a catalyst moves the market, one risk interval or longer, we call that irrational. Do you all understand that? Is the risk interval bands, yellow line, red line, and TOS drawn by a script? Yes, just to make it easier. We're eventually going to get them in Rocket Scooter. We're working on them now. Essentially, the way that it works, I'll give you guys the manual way to do this. Okay, do me two favors. I'm gonna give you guys. I want everybody here to go through these steps. Okay, step one. I'm gonna take a quickie restroom break. But do this. Step one. I want everybody here. It's free trial. You don't even need a credit card. You just type in your name and your phone number, and you get a free trial of the platform. So go to rocketscooter.com. Sign up for the platform. I'm going to walk you guys through the interface and show you how to map out everything in this risk interval bands. Paul and everybody, okay? So go to rocketscooter.com the next minute. Sign up. You'll have the platform access literally in 1 minute. No credit cards. There's no like hidden charge if you get to cancel. It just cancels you. You're goodbye. Or even cool like that. Like we don't want you guys to have a hassle. Just go in and sign up. Number two, Discord. And I want everybody to go to the Discord right now and go through the 2 steps to get into the Discord. And I'm gonna take a quickie break. I'm gonna come back and share with you how to load up all this stuff in your charts, okay? Pretty cool. Okay. Everybody go there for 2 seconds. I'm gonna take a quick 2-minute break. 2 minutes, that's it. And after that, I want you all to go to the Discord. I want you all to go right here. Okay. Be back in 2 minutes. Yeah. Be right back. All right, I'm back. Whew. Yeah. One second. All right. To go to the Discord, everybody signed up there. We're good. Okay. If you go to bots and indicators, it'll give you all the information that we have that's not in Rocket Scooter yet. So we use bots to give some of the information to you before we get them in the platform. So get everything in the platform little by little. Risk interval is the green line, it's the green dot. That'll give you those, what we call the doomsday bands. And you can manually draw them on your own charts, your own Thinkorswim. If you are a lifetime member, our lifetime members share custom-made scripts with each other while we have indicators that are in what we call beta. So Doomsday was being tested for a while, and while it was being tested, one of our teammates just whipped up something and shared it, so it draws these bands on the chart for you. All you have to do is come to Thinkorswim, you hit Control E to bring up the strategies panel, and then you can go to the settings and you type in your risk interval and it just draws green lines for you. You can also very easily just draw those line segments on your own as well. But the distance is this distance right here from the close. 27.5 up and 27.5 down. You can manually draw that, manually do that. We're gonna have Doomsday drawn on the Rocket Scooter platform for SPY, just to test out converting those futures to SPY effective levels, which is one of the things we're gonna do. So you would take that 27.5, right? 27.5 for ES and make that 2.75 SPY. It would be where SPY would close at 4 p.m. Or sorry, where SPY would be at 5 p.m., which is when the Globex closes, which is 1 hour after the stock market closes. That level is SPY plus 2.75 either direction. So that's basically what we're going to do to draw it. There's a lot more steps to be able to draw it. We need to do the green lines first. We need to parse that data from the actual CME published site, and then of course add that algorithm that searches for all that stuff and does all that math on our database, and then we can draw the green lines. For now, we're probably just going to hard code it in there super quick. Like I can go into an admin panel and manually change it, and then it draws it for you guys on the charts a different way. What would it take to invalidate your end of Europe thesis, finding lower lows? Fundamentally speaking, the Fed aggressively raising rate hikes faster, going to a full point or higher, or the S&P finding lower lows. One of the two. Basically it. Give me 1 second. So today, nothing's going to happen till FOMC. We're going to chill. We might talk about some educational topics while we're waiting. If you guys are cool with that. Or Putin sending new... Yeah, I mean, the world can go to shit pretty quick in that environment. Okay. So no plays really today. I am watching things pull back. This is the Apple. I just have it up front because it's the only real kind of active trade I'm really contemplating doing anything with today. I'm going to be in YouTube or Zoom. Probably stay on YouTube today and then go to Zoom after. So if it's your first day in the free trial, you need me to walk you through some stuff. Feel free. We made a new video yesterday. You guys can go watch if you guys are interested in seeing these new videos. I'll show you where they are. So as a free trial person, your first day in the channel, the quick strategy guides have all the stuff that we talk about. Liquidity map is there, trading strats are there, stop rules are there. All the stuff you hear us saying, like irrational market, irrational market, irrational market. That's where that comes from. Matter of fact, look at this, make that look a little prettier. Just polishing everything up. What? Extra characters. All right, we gotta delete some words. Even on occasion. Even rarely. Random at this point. Need to reiterate what liquidity pocket is. Be a little easier to see that. Make it look a little prettier. Okay. Nicer. Okay. Stop rules, liquidity map, trading strats are there. All the bots are there. Yellow lines, red lines, and the Doomsday bot talks about the experience point. A464 was the Doomsday calculation. Is that today or yesterday? I think that was yesterday. Double check this. That was yesterday's. Okay, cool. Your review yesterday? Oh, thank you. Yellow lines, off bear catalyst impacts. Draw yellow line, interval down from bear impact. Yeah, same thing. You draw it up, you draw it down. Same style, same thing. Let's do a quickie, like as I like NVIDIA as some of the better trades. You know, the FOMC might kill the market very rapidly and very aggressively to the downside. I am probably just going to liquidate this Apple just to free up some cash so I can actually trade something better. With SPY pulling down, NASDAQ pulling down, everything pulling down. My Apple is relatively flat. There's not a lot to say about it. Oh, by the way, that's Financial Juice going wee-oo. And it says, oh, this is the EIA report for crude oil, so you might see a little spike or move in crude oil. So Apple is still hanging pretty at hedge pressure. I'm not liking it. It's been in the money for a while. That's actually where I bought Apple. Exactly my entry point. I think I bought Apple maybe like a week ago. Can't remember, to be honest. And it was a starter position for a new expiration. Let me see what my buying power is. Double quick, just to make sure I got enough room to trade. How much is that Apple? Okay. Yep, not maybe pulling anything up on the scanner, but just go through some scanner techniques. Like if you want to find something that was just like SPY, right? And the cool thing on the scanner, you go and you put up an index like SPY. You put it front and center, it's a bear short up. You can actually sort by other stocks that are in that bear short up setup. which will look like this. And again, the liquidity map cheat sheet is going to help you see where that liquidity will be. So where buyers and sellers will be. Bear short up has that kind of bouncy between hedge pressure and monthly. So we put them like this. Crude oil inventories. Thanks, Mark. A draw beyond a almost flat prediction. Previous was a build, so there's a draw. Interesting. Bigger draw than I expected. So there's all the bear short ups, right? You can see them here. I can also say that SPY is below half gap with resilience being negative. So I can go here, I can go to other stocks that are above half gap and see if there's anything that's actually trading higher that would likely come down and follow the SPY, right? So I'm looking for things that are lagging the market. I don't know what this stock is, but it's certainly a penny stock outside of my comfort zone. I don't trade those little guys like that. So here's another thing, right? It's a bear short up against monthly hedge pressure. So EW has that. It could catch up with SPY to trade from here to here. So there's not that many options today in that particular setup. Everything that's fallen is pretty much going to fall. Want to really further, let's get rid of that one. Let's see the ones that are above monthly hedge, because resilience is below, meaning that the SPY is kind of on the fence here. If the SPY for some reason to start rallying go higher, you can see that monthly hedge being at 0 or around 0 means that it's a very balanced market. There's a lot of things that are going to be, as you see, right there on that edge. And we're going to sort by distance of hedge pressure. Let's find the stronger of all of them. Dow, Q, Snow, TSM. These are ones that are pretty much right at that monthly. So when FOMC comes around, this is why I had you guys go to the Discord. This is the trick. Okay. When FOMC happens, from the moment of impact, you draw another band of this distance on just the S&P, 27.5 points above or below that level on FOMC, wherever it takes off. So I'm going to do in Thinkorswim and show you how that works. I'm going to pre-prep in Thinkorswim. Let's go to an intraday chart. This is a really cool trick, so don't miss this trick. Yeah, there's definitely a huge miss on that. So I'm going to draw a box, just a random box. 27.5 points. I think it was the last 4 out of 6 FOMCs we've had this year. I think they say rallied. I can't remember the stat. Bar chart posted it, I think I retweeted it. But a majority of the FOMC days end up rallying. Just keep that in mind, right? So I'm going to make it 27.5 distance. Here. And say that the FOMC statement comes out just now, right? I'm going to just draw a range like that. So from the impact point, which is the moment the market is the price of the market's at when the news comes out, that is the predetermined price that the market's expected to be balanced at. For instance, if the news comes out right now, you typically trade to pre-price in the news. And if it dips and returns to that price, then FOMC has effectively already been priced in. It's no longer part of your decision making. So pretend that it launches from here, and that's the moment it happens. We call it the impact point. Anytime you blast through 27.5 points, it's irrational again. So as a trader, I like to say the impact to drop 27.5, and then I long for that retracement to gap fill. That is one of my favorite scalps, and I've taken almost every FOMC this year. Grab some futures, let them go. Easy as that. Make sense? So if it falls below that catalyst, if it falls below that range, then it's irrational and we sit out. That's the rule. Remember, the rules here are knowing when to sit out at the right times. And if you go to the stop rules, when there's a catalyst, I will exit both a winning trade and losing trade, one risk interval from the anchor point. So that's exactly it. If the market moves 27.5 points on the futures, that is an exact range test, and that is okay. So I want the market to dip in return, and with that DD being greater than half, I clearly want to buy the dip to touch the upper band. So we're down here. Let's just imagine that the FOMC is somewhere down in here. If it dips outside the band, nothing. If it returns to the band, I'm longing the fuck out of it right here to the top. Do we understand? It's the point in time. Don't think of candles. It's the point in time. So whenever that decision comes out, it's that price that it was at that moment. Go to a tick chart. Is doomsday essentially like a margin call for intraday traders? It's related to margin calls 100%. Outside the bands, the risk of margin call is very high, but it's not just margin calls of you and me. It's margin calls of market makers and others, bigger institutions. Since margin requirements are set based on expected volatilities, then therefore the expected volatility will imply margin call probabilities are high. So they're hedged very heavily. An example is if I were to draw like a graph, turn your head sideways in the middle of this band, that the probability of margin calls outside the band is very high. And let's just call this like infinity 0. Like turn your head this way and read the chart. Giant, I guess you'd say so it's a very high probability, like very, very, very high outside the band. But when you come in the band, it rapidly decays. I'm talking like so inside of the band, nice and stable, the probability is very low. As you exit the band, that probability starts to like speed up really quick like that. So margin calls, we get margin calls, etc. So it's almost like, and actually it's probably more like this, like a giant cone, if you may. You have to draw on the charts this morning. But yeah, margin calls very high probability outside of here. So what you see is these levels are hedged very heavily to prevent that from happening. The market's illiquid, so it's not hard to fight off a one-sided move. But again, if the one-sided move wins, the market will topple on itself. Typically, it wants to return to inside the band if it can, but a lot of times it doesn't, right? So it can cause this just squeeze days where people just get squeezed super hard. And anytime you touch the band, you can always see there's abnormally high volume because of that hedging. And again, it's predictable. Like anytime you interact with these bands at any point in time, even overnight, look, overnight, 2:30 in the morning, you're touching the band, look at that irrational volume. There's all that hedging there. And when you squeeze through it, look at this, right? That's where those potential squeezes and those margin calls can happen. So anytime you interact with the band, the volume is extremely high at any point in time. It's one of the first exploits we created, and it was actually a fan favorite for the longest time. Doomsday, that ratio made it actionable. Doomsday was a correlation. It was an idea that we had, and I actually came up with it live on the stream, which is pretty cool, is that when Doomsday is greater than 1/2, then without a catalyst, the market wants to touch the upper band at least once. We found that correlation, again, if it's testing the volatility without a catalyst. So that Doomsday band being greater than 1/2, anything that dips and stays rational, I want to be long to go to the other band because that DD trade is still active. If you open in the range, then that is good. The risk to the reward is very low at this point. My stop is here, my reward is there. It's a really good trade. Do you buy futures at the announcement or when Powell speaks? I usually buy something going into the announcement, something small like a micro or two, just in case it rallies there and I can close it out. Or I have a micro or two, or not or, but if I have a micro or two and it dips down to here and falls below, I can close it out and then I can long my minis right there. So I like to get something on the initial burst, but something small, something I don't worry about losing. If we're down here though, probability is really high that I'm going to long minis instead of micros. So if we were floating in the middle, a micro to catch that, a micro to hold, and some minis to dip in and buy. But I want to trade from here to here. Easy as that. But by the moment the announcement, look at, all right. So it's just, you know, like right before the announcement happens, you can just subtract 27 points in your head from whatever the price is. Does that make sense? Yeah. So really nothing to say until then. We'll do some quick educational lessons really quick. If you guys can make sure you like the stream and say you know, get some comments or whatever. We'll do a quickie little educational session. Do I trade on Tradevate? I do. Not lately. I've been using Thinkorswim lately just because of the stream, but I do have a Tradevate account. So I've been trading my futures through Thinkorswim, as well as my options. I like that DD band being where it is. I also like the idea of S&P monthly hedge resilience is like right on point at 0. That's all looking sharp. I'm not disliking this market. What is the current S&P margin requirement for futures? We go to here. Site. Performance bonds and margins. Requirements. We go to. Okay, this is how you look at it. Gimme group. Now your broker. These are the performance bond minimum requirements. So your broker can always make these more than what the CME says. So the maintenance requirement is 10,000, so it's 110% of that. So it's $11,000 the S&P. How you do that? You trade ES or MES? Do you trade options, or do you trade options or as like stocks? ES and MES are just like stocks. When you trade futures, it's a very similar mechanic to trading stocks. There is a fixed gain per, you know, stock goes up a penny, you gain a penny. Futures go up a tick, you gain a certain fixed price, and they go down. It's the same way. So futures is a lot like trading stock. There's very little difference mechanically. You'll notice you don't have to pick. There's the mechanical differences you likely won't notice as a retail trader. For instance, if you have futures expire, so when that contract expires, there's something called the last day of trading. You can't trade that contract anymore. So your broker will close your position for you when that last day of trading approaches the final time of trading. There's a time that you can't trade past. Your broker will close out your position. You have to grab another one. So futures will have different contracts that expire different months. Just take note of that. Yep. But in reality, day trading, you wouldn't notice the difference. It would liquidate you at the end of the day. You would be selling your position at the end of the day anyways. So you don't really ever mechanically, as a futures day trader, see any of the differences between trading futures and trading stock. It'll feel the same to you. The mechanical side of futures will have different components to, like, your account. For instance, you don't need an account minimum. You don't need to be a pattern day trader. It's a completely different industry, regulated completely differently, usually cheaper to trade. You can trade around the clock. You're taxed better on futures. There's a lot of neat things that futures come with. And actually, I was on a podcast, recording a podcast last night with the Trading Camp folks, And one of the things I did talk about was how new traders tend to flock to options because they see people trading them on Twitter, and you get these big, 500, 600% gains, and everybody's like, look at all these YOLO gains I made, and all these big, like, I made this big fucking trade and options, and the future traders like, leverage, please. Just like, they're not, the futures traders are like it was a stereotype that was like the older, more sophisticated crowd. The big boys only played futures. I mean, you're leveraged up 25 to 1, 50 to 1 sometimes in futures. Your little $500 levered investment, or your intraday buying power, could lose 50 grand because of the leverage. 100 times, Mark. I mean, like, the amount of swing is just huge. Futures are extremely leveraged. Futures are that same kind of leverage. It's almost like 0-day out of the money options. I mean, it has that same feel to it if you're not careful. Yeah. There's also no Greeks. Yeah, the whole point about options being complex is that people jump into options for the hardest thing in the world to trade. You have to not only pick a price you want the stock to go to, but you have to pick that price at a point in time and guess how it gets there. If it goes straight there, you want to long the option. If it's going to wiggle its way over there and get there and take a lot of time, you might want to sell calls on the other side of it. I mean, options are so complex. New day traders literally are walking into a trap, jumping into options. If you don't know what you're doing, options are extremely hard. New day traders should always trade futures. There's no better thing to do. It's catering to new traders and they don't even know it. You don't need an account minimum. You can put in $500 and trade nano futures, put $1 in your trade. And you can pattern day trade all day long. You can trade the index, which is extremely liquid, and not have to deal with the mechanics of Greeks, picking a price at a point in time, and does it go there straight or does it wiggle while it gets there? Those are the problems that options traders don't understand when they jump to options. You could have bought 384 strike calls in SPY, and once it gets there, you can still be losing your trade depending on when you bought it. So 50 MES, like 50 shares of SPY for P&L. Yeah, something like that. Can you explain your play for SPY QQQ on FOMC? Yeah, no problem. So for FOMC, I don't have anything going into the play. We have a clue today that Doomsday is greater than 1/2. And if you guys go to the free trial, you can get all this information yourself from our Discord. DD being greater than 1/2 means I expect the market to go here and touch the line at least once. So I want that FOMC to come out being the same, 3/4 of a basis point or lower, and the market's likely going to either bounce to here and rally, and I'll close my trade there. Or if it falls below that green line, I'm out for the day. There's another irrationality that comes forward, and they're both going to be possible. If you see right here, let's pretend that the FOMC comes out right now. We take a risk interval band, which is 27.5 off the event. It's also irrational, but it's going to break the risk interval band first anyways. So the market, anywhere below this green line, I'm not trading. Anything below, period, no matter how it gets there, it's not going to trade at all. Anything to the upside, let's pretend that it starts there. Market is now deemed irrational here before it even breaks Doomsday. So ideally, I want the market to go here, and then DD will tell me I'll touch the upper band. It's already irrational to the upside, which could cause a very massive short squeeze. What platform you suggest to trade nanos? Trade8. I forgot who is. It's the Farex, I think, is the name of the exchange that does nanos. They have like a Bloomberg 500, which is basically the S&P 500, and they have the Super Tech 100, which is just like the NASDAQ. So my strategy really is going to be to long at the dip. If the market goes outside the band and then returns to the band, I'm long here to touch that band, and then I'm out. Very possible that the market volatility does that. VIX is starting to climb, which is implying the volatility is going to be here. The Bloomberg nanos sucked when I told them horrible feels. That's the problem, is that they're just illiquid. The futures industry is not attracting the big crowd that it should. People like us are making awareness of it. But I mean, the kids are going out there trading options when kids should be going out there trading futures, nano futures. Now liquidity needs to be there. It's the perfect place for you to take $50 of your allowance money and actually day trade with it. No limits. But nanos, the problem with nanos is they're very illiquid, as Marcus said. you're gonna have a hard time getting good fills. Micros, maybe not. So, you know, trading micros is gonna be probably the most lucrative of you know, I guess the middle ground of all of that. Micros will give you $1.25 a tick on the S&P. So like one micros contract, you're up and down a couple $100 a day. On a $5,000 account or greater, that's not terrible, right? It's 2%. Or 4%, whatever. You're not really like nuking a $5,000 account with one micro. Ideally, you would like to have some granularity on that and play with like three nanos or 5 nanos or something. But $5,000 or greater micros are great. $25,000 give or take later minis are great because if the margin requirement's 11,000, you want to make sure that you have 11,000 for each one you buy. Never use margin with futures. It's the stupidest thing ever. And that's the scary part. So if the CME group, like I just showed you, charges you a certain amount for that contract. Here's how futures work, right? So CME sets a minimum margin maintenance requirement that all clearing firms, which a clearing firm is a bucket that asks you, if you long and somebody shorts, the clearing firm is like the bookie that sits there in the middle and says, okay, you guys put in your money. You got to put in, to hold your position, you need 10,000 in the bucket, you need 10,000 in the bucket. To enter the position, you need 110% of that number on the CME group. So 11,000 each. I put in 11,000, you put in 11,000, and then since it's a cash settled instrument, when one of us closes, it's like a swap. The cash flow goes to the winner of the trade, and the clearing firm ensures that happens. So to make sure that clearing firms and brokers don't go bankrupt, they set these minimums because a thing is that your broker can charge you intraday $500 to trade this thing that they require to cost 11,000, right? So that's, you know, 22 to 1. It's a huge leverage. I'm leveraged 22 to 1 if I use my intraday buying power, which I don't. My broker charges 500. If my $11,000, I can buy 22 contracts. Blech. Well, that's a stomach ache you don't want, trust me. So if it's 11,000, you pretend that you don't get that margin requirement that's $500. Don't ever fall into that trap. Trading on margin is a trap for new traders as well. Use cash. You're not good at trading, don't accelerate your losses. You're gonna accelerate your gains, trust me on that. Next thing is that the clearing firm will require of the 11,000. Your broker says, oh, it's only $500 for you. So you put in 500 and they put in the other 10.5. They put the rest in the bucket. So your broker's on the hook for the majority of the cash. So these are set based on the probability that brokers can't cover those positions. You guys remember what happened to Robinhood and GameStop? They didn't have the cash and that to clear all those trades that were being liquidated on margin calls. They overcommitted to clearing, right? And then Citadel had to bail them out. There's a big cover up on that, right? So you have to think about, it was Robinhood, right? The futures, whatever they tell you, ignore what your broker says. The safe thing is to only trade what that is. So when I say I need about 25,000 in the account, which means I can buy about 2.3 minis, which is 23 micros, give or take. Because I'm pretending that I don't get that bonus, right? My trades right now, I'm in December 9th, 310 calls on QQQ for December 9th. Very aggressive. It is over a month out. It is to fill a gap on the last wave up. And I'm taking that position. I'm just buying that position while it's cheap now. I've got Apple and Google, same setup while it's cheap now. And I'm gonna just trade this guy's higher if we do to get that rally. So hang in there for 1 second. I'm gonna take a quick break and I will be right back. Actually, let me just do this. I think I have a main no camera. Okay, right back.
soul I wanted. If you let me hold your hand, as long as you understand that I will run with you till we're falling. Every night, every night. If you let me hold your hand, as long as you understand that I will run with you till we're falling. Every night, kiss you on the night.
Want to listen ad-free, download music offline, and keep songs playing in the background? Get YouTube Music Premium.
Woo, we're back. The song playing right now is it's on a playlist. It's called "The Love of Yesterday" by Paul Ogg. I know, it's pretty chill. All right, what if Fed increases interest rates? Gold will go down. Possibly. It's a really weird environment that we're in to kind of draw those relationships. I would say that we're gonna let's look at gold really quick. How it's been trading. Should we pull up the GLD ETF? So we have what, 3 hours until Fed? Okay, make sure you guys do me a favor right now. If you want to capitalize on the free trial, if you sign up the free trial today and you sign up for Rocket Security, you know you get half price off the monthly sub for the rest of your life. If you join our program now, you're in that cool grandfathered in crew that will always pay $100 a month for the platform, for the data feeds. All the new stuff that comes through is yours to keep. You don't have price raises, nothing. Final platform could be $300 a month plus the Discord and all that stuff comes with it. Education, materials. So when we get to our first 1,000 members, it's going to be $1,000 a month. I mean, $100 a month per person, which is probably cheaper than most rinky-dink trade rooms out there. It's very inexpensive for you guys to join our program, learn what we do, learn trading from us, but also get to use the software. So go to the free trial to rocketsecurity.com. There's a button in the top right corner. Ooh, I forgot about this. Get down here. Try it out for a week. See, I know gold's been going down since the beginning of March, I guess. I haven't been really following or correlating gold with anything other than it is trading against the technicals of itself. We have been raising rates for a while, and obviously, gold has been trading down, but I don't know. I don't want to make a strong correlation between the two. I think that in a type of cost push inflation that we're experiencing, the FOMC rate hike has very little effect immediately on the price of things. You raise rates to slow down and destimulate like lending and spending of consumers and lending by banks and things like that by raising rates. That tends to slow the economy down, and people could see that that's possible inflation happening. The Fed's going to curb that, and you might want to long gold in that environment. I would say that in general, this environment's different because the rate hikes aren't going to do anything to inflation that quickly. Inflation was caused by labor bottlenecks and supply shortages and raw materials, things like that. Fed can't control that. Actually, if the Fed raises rates, it could possibly slow down the recovery, and the opposite could happen. You raise rates, Wall Street flips out and starts selling all their stock, and then companies' performance is a little more magnified under the microscope because the market's a little more sensitive, so less forgiving. So markets can collapse or tank when Feds are raising rates, which can cause companies ultimately to lay people off in the period of inflation. It causes stagflation, the problem everyone's talking about. We're not in stagflation yet, but we could be if the Fed overly tightens and crashes the market. So in particular, I wouldn't correlate anything period to the Fed rate hikes. Maybe the Treasury market is about it. I would say it would have some kind of correlation just because Wall Street's looking for something to trade that's not necessarily equities. Now in the last month, you can see they're starting to pile into their equities positions. We watch that every morning. We get to that Commitment Traders report. You can see that Wall Street's appetite for stocks at this level is very high. So you can see that green line is the asset managers starting to long the market as low as 3,600, and even down here at 3,600. This is a palatable long for Wall Street. So I'd expect as we're starting to move into a favorable side for long in equities, you might want to see that the trade in the treasuries is getting nuked, and that's exactly what I expect to see, right? So yields are going up because treasuries are going down. Why are treasuries going down and yields going up? Yields go up to attract people to the notes, right? And why are they going down? Well, because if you have a period of inflation, right, the dollar becomes less and less and less over time. Now, this is the 20-year, but in an inflationary period, I have a dollar, right? And in a year, at 2% inflation, I really only have 98 cents of buying power compared to last year's loaf of bread, right? And then 2%, 96 point something, 95 point something, I don't know, 8, whatever it is, right? It gets smaller and smaller and smaller and smaller and smaller. So when you have something that matures with a fixed yield, as the years go by, as inflation goes up, your fixed yield is less and less and less. You might get your X% yield, but the dollar amount could relatively be nothing because the inflation reduces the amount of that fixed return. So since it doesn't scale in inflationary environments, people don't like the long treasuries and be long fixed income. Cash is king right now. That's what you see. So right now you can see that the yields, when premiums are down, yields are up, right? So when yields are starting to go, or sorry, when premiums are going up, it means the bond's very attractive. It means the yields are high enough that fixed return, whatever it is, right? If you expect in 5 years the recession to be over, then however much inflation you're going to experience after 5 years is your actual return. It's your effective return, right? On your investment. If that return is greater than your return on equities, then people will start to long the bonds. I mean, the yields have to be high enough for that to be attractive. They have to be high enough to absorb the sink of losing value on your returns because of inflation, right? So inflationary environments, you expect bond markets to collapse, which is interesting. So is gold a hedge against inflation? Just like, is crypto a hedge against inflation? And these and that? I mean, traders will tell you the answer. Here's your hedge against inflation. I mean, gold's been trading down for nearly 3 years. Is gold a hedge against inflation? Fuck no. Maybe in the 60s and the 50s, but these days, no. Right. So maybe in different environments you can see, but during periods of quantitative easing, gold comes down. In periods of in periods of, for instance, recession or market collapse due to a bubble popping, gold becomes very attractive because it's a safe play and people are used to making that trade. But in this environment, in this recession we're in, gold's coming down. It rallied on that same mechanic, but you can see that there really is no appetite for gold either. Commodities are losing pressure because commodities were overinflated in COVID, right? COVID created a scarcity of raw materials, so COVID attracted traders to come in and buy the stock, to buy things that were tangible that you can hold in your hands that could be scarce. So COVID created a scare in the gold market, but gold is just stabilizing off of that. Makes sense. It's a hedge against itself. Why do central banks buy gold? Probably hedging against themselves. Well, I mean, in any type of environment, you would think that tangible stuff, especially in cost push inflation, means that you have a shortage of tangible assets. The liquidity's gone. So why would you buy gold? If the liquidity is gone in general, you'd buy anything that's tangible because raw materials go up. Remember lumber and all those other things. Gold had that same mechanic, but ever since that vaccine came out, like in August of 2020, right? Gold's been collapsing since the COVID vaccine came out. So, the idea that COVID was going to create a zombie apocalypse, people are going to start stockpiling lumber, gold, oil, everything, which they did. But as you see, gold lost its steam when that vaccine came out because the world was no longer going to shit. What do you think about the idea posited that the Fed could increase reserve requirements of banks to construct money supply that cause a collapse in institutions and people are forced to deleverage? Could be. Yeah. Could be. But you have to think that the Fed doesn't want to collapse anything because they're the ones that will be bailing us out if they do. To me, it sounds like the Fed has no incentive to put strain on the market. That's just me, though. Does that make sense? Yeah. I mean, it very well could. I just like to think that because of the way the Fed has orchestrated QT, it was to announce QT at the period the market was most liquid, coming off of the COVID short, where people shorts and longs were squeezing. Market's very liquid. They kind of like depressurized it when it could. So had we not come out of COVID, had we been like right here, they announced QT would have induced a very rapid sell-off. But as the market was dipping, there's enough COVID shorts still covering to get out of the way because they bet on a round 2 that they never got, right? And also people that tried to short early on in QT itself are now locking in profits for the tax year. And you're just seeing that there's this mechanics right now. The Fed is going to press until the market can stabilize, and then they're going to press some more, press some more, and press some more. Rate hikes can go really high. I could do 2, 3, 4 basis points sometimes. You never know. They've gone high in the past, but the Fed's not going to aggressively drive us there to push into recession. The government be knocking on their door a year later, asking for them to start printing money again to bail us out. And the Fed might want to do that if they want to crash the market to zero and print money and buy everything from zero. Sure, I guess. But then at that point, there's a lot of work for them to make a little bit of money. Purposefully crashing the market. There's no incentive for them to do that. The risk is insurmountable. They just have, there's so much. I mean, the leveraging and all the stuff they'd have to do to dig us out of that hole. The economy would come to a screeching halt. It won't even slow down. People start getting laid off on the stock market crash this soon, right? Surprises happen and the market starts crashing. Like, I mean, crashing this year. People are getting laid off to a degree that we're going to have a Great Depression. It's that bad. There's no bailout situation. The Fed won't have the ability to bail us out, right? We'd have to create all kinds of things, and it was going to be pretty. At the open price at 2 p.m., yeah, it's the price before the event happens. So it's not necessarily the event. You watch, and you put a tick chart on. It's easier to see. I'm going to use a 233 tick chart, and that's all I'm going to do. Tick chart is like time independent chart. So you'll start to see just a flutter of candles that aren't overlapping. Yes. So it's technically that time, but you can mark it on the edge of the previous candle to be accurate, but then you need to go to the chart and very quickly just, you know, okay, say, oh, it was actually here instead of there. And then make sure you get it exactly. Fed can't raise rates too much because there's too much debt in the system, even government debt. Yeah, I agree. Liquid gap closing, post Fed on SPY. I think so. I absolutely think so. One second. Yeah, so if you're looking for Doomsday today, play. I'm gonna tap the lower band, trade to the upper band. I think that'd be appropriate. That's like falling to a decent level here. Good to see. Let's put ES front and center by proxy. Oh yeah, I forgot. I had my ES scalp from yesterday. I did and close it in the overnight, so it's still showing that 150 bucks. Let's double check where we are here. All right, I'm gonna check Rocket Scooter really quick. We're gonna get our calculations done on QQQ. So we'll check these. Got what? 3 hours, 2.5 hours still fed. Ooh, right at monthly hedge. We're like. It's looking super gross today. Let's double check UVXY. We watched that to make sure we don't have any irrational flags on the VIX. Just on today's setup. Let's do a monthly map on Qs leading into next week, going to Fed. Pretty okay. If VIX passes 10, it's a bad deal. You get to that call territory on VIX, that's not a good sign. Yeah. Right, let's do a quick monthly map, and we're going to do this on Qs, right? The old classic app up. So you guys to do a monthly map, so I'm going to plan out months of Q trading. So here, let's go to daily chart. Actually, I'll do a 4-hour chart, make it a little easier to see. I'm going to draw some boxes just to kind of have some show here for you guys to see it. This is the monthly map. So monthly maps are great for me planning out swing trades and finding out if I want to long or short the market. Monthly maps are one of the best things you can do with our platform, by the way. So what I'm going to do is I'm going to map out today's expiration, a single date. I can see that 278. Okay. 279 is the bull side today. I'm just going to do daily. This is the general trading of today. Right. And I'm going to make this just like a darker gray to show the bull side. We will have monthly maps coming on the platform sometime this year. All of our sprints are designed for this year for the stuff we have as far as indicators go. Green lines, red lines, yellow lines, doomsday, all that's planned for this year. Good. Okay. So what you're going to do is you're going to click a single date, or on the old app, it still says monthly mode. I'm going to pick individual dates themselves. Friday, for instance. Look at the positional spread for Friday, 280 against 275. Wednesday, Thursday, Friday. And you're going to see that the market is becoming slightly more volatile as the range gets larger. It's more volatile going into Friday. Let's be very clean. I got them to expand how many days we can pull. See if it works. Haven't done it yet. So again, we pull all the data on our end, but we only let you guys pull so much data on your end. 266. Wow. Because before we were expanding, we just kind of were, scaling up our servers. So now we've had it. I don't think we announced it, but there is a new expansion on how many days you can pull. And so you can now generate data, I think, for up to 5 weeks, if I'm not mistaken. And some of our data providers aren't providing data for some days in this event, so we actually found a little bit of a hiccup here. How far out we can go. It looks like we can't go any further yet. Oh, we can. Oh, maybe the 18th. Let me double check this. It was under my impression they had released that, but I guess I'm gonna double check that with them today. Thought we could pull out more data. 300. So let's show this. There's a put resistance at 300 on the expiration on monthly. There's 280 to 285. Bull side. And then a lot of jumble, and then oh wow, there really is no solid bear side. It's all jumbled for monthlies. That's interesting. 275, 270. Just kind of want those as copy. 265 lower bull. Okay, interesting, right? I'm not gonna draw the little bull wall in there. So we are certainly bearish for the next 2 or 3 days. But as soon as the 7th, right, Monday, it's certainly still bull side if we fall and hold here for 3 days. So a bull wave could be along this path. And you draw it like this so you can see that if I want to be bullish, I want that to happen. Right? So anything today that goes below here, say bye-bye to my swings, my bottom thesis, because to tap the lower band, it's going to double bottom. So the FOMC hopefully today can collapse the market to that bull side going into Monday. We should be fine. Ideally, what I'd like to see is something like that, and like that, like that, like that, and then slowly pick up. That's what I want to see. How's ED calculated? Is there a way to leverage this tech for consistent overnight plays on S&P? Yeah, every single day we release an overnight calculation called the dynamic hedge pressure. Dynamic hedge pressure overnight is ridiculously good at what it does. It pivots the market. Well, I'll just show you what it looks like really quick. Those dynamics, we're building those. Another team right now is actually building those things to display on the market security charts as well. Let's go to the S&P. So the Discord bot, which right now is on hiatus, I need to fix it. But I do post the output manually done. Normally a bot will post this and it'll say above high hedge pressure, it's bullish, below low, it's bearish, etc., etc. So I'll draw it and I'll show you the rules, okay? So I'm gonna draw these numbers. You can follow along by going to the Discord. If everybody can go to the Discord really quick, click this link below. If you've never joined our Discord, click this link. We have a free Discord. You can join and get all this information for yourself. Oh, there's a video on it somewhere, but let me cover those numbers. So let's draw them really quick. Right. So today, it's fairly simple. So the numbers come out before the market opens for the overnight. The rules are like really just, I mean, the way I use them, rules are pretty clean. So 38.44 to 38.49. 38.44. 38.49. Let's just do that like that. I'll draw it blue because it's hedge pressure, and we'll do right extension off. Show name, sure. Your price. Okay. And then you'll have 38.49. And then monthly is 38.44. When you interact with it, they're pivots. So when you're above, essentially, if you think about it, it's the easiest way to think about it. You know how liquidity map works, right? Ollie, there's bull, there's long, there's up, things like that, right? Those words. So dynamic hedge pressure is an estimate of where hedge pressure likely could be in the event that the market doesn't go anywhere. So in this event, it's trying to get 16 hours ahead of the real hedge pressure. But what we notice with this calculation is that anything above the highest high is considered a bull pivot. Bull pivot, right? Doesn't mean bullish, it means bull pivot. So here, it's likely to pivot higher. here, it's a bear pivot in the overnight. So if I wake up and I tell myself, bull pivot. If it falls to there, I'm going to long off of there. And then long again off of there and stop right there. If you go even further to understand what it's actually estimating or showing you, you understand that in general for Rocket Scooter, when you look at the liquidity map, and search for like some bull long ups, for instance. $4. On the liquidity map, right? Bull long up is saying that you are, well, let's find one where the senses are different, where they're not the same. Johnson. So in a bull long up, you know that you get that long pressure from hedge pressure, and the up is the distance, it's the orientation of hedge to monthly. So it's just the same as dynamic, is that, well, you guys understand that if you're above hedge pressure, this will say L. That's just a code for that. There's more long hedging than short hedging. If you're below hedge pressure, this will say short or short orders. The orientation between shorter term day-to-day sentiment and the overall sentiment is up, which means this is a bullish overall sentiment orientation. The difference between up and down is a difference in how I trade the thing. On the liquidity map, the difference between bull long, right? All bullish setups, but the hedge pressure on the monthly side is oriented the other way around. You can see there's a little bit more of a, this is more like the market's sustainably bullish. This is like the market's hitting some strides. Down here is unusually volatile, and so there's a little more trades that pop up. Difference between bear, short, down versus up, it's very similar in its direction, but there's a little bit more of a potential for squeezing against the trade because of the up. So, but some of them have drastically different trade plans, right? Bear long up versus down, one of them I'm only longing, one of them I'm only shorting. So there, we found that there's a very drastic change in probability on some of these, okay? So the long up, long down, long up, long down can have a huge change in how I behave. So the dynamic was an attempt, when it actually was created. Dynamic was created at the end of the day. I can calculate dynamic to know where I put my puts and calls. An example would be if I were to long the S&P, say long SPY shares at the end of the day, and I'm stuck in SPY overnight. Actually, let me start. Let's say that I was to long, I don't know, long Meta, right? I bought Meta at the dip. Market's looking kind of crummy, and I want to hedge Meta overnight in case the stock market continues to collapse when other markets are open and we're sleeping. So if I was longing Meta at the end of the day and I needed some options to hedge my Meta plus all my other portfolio, and I wanted some put options, well, I'll know that the market likely is looking for a long right there, but anything below here definitively is a collapse, okay? So I'd want to make sure that here, at this point in time, I bought puts for this strike. Because that's when I'm sure the market's collapsing against me. So if I buy Meta and a bunch of stocks, the market's falling, 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 I want that delta to be 50 or higher when it starts crashing the bear side. Just use the end candle at 1 o'clock central illusion. That's, if you can't do tick data, use the 1 o'clock candle. Does this make sense? Ollie, pretty cool, right? So yes, liquidity map on past days is an actual graphical challenge. The only reason we're not showing it is because it's really hard to show, and I'll talk to you why it's hard to show on past days. We have to create a different layout. So do you see how this works? That if I were to buy puts just to hold me overnight until the market opens, then I'm just paying premium on those puts in real time, and if the market opens favorably, I can just close them out. But I can buy insurance at the end of the day for that strike and that strike, just in case the market falls, and I'm buffering my loss on the stocks I bought, right? Okay, another thing. All right, say that I long, this is why it was invented. Say that I long stocks and the market starts collapsing overnight. Well, I can short futures to hedge the long of the stocks. Say that I'm long stocks, But market starts falling, I'm shorting futures, and market falls to there, to there, to there. I can X out of my futures trade to get out of the way. I hedged a little bit of the move, and then I expect the market to hang around there. If I hadn't done anything at all, and I just wanted to straight long futures, I would have done absolutely nothing overnight. If this falls to here, I would make a decision. Now remember, if hedge pressure is here or here, and monthly is here, then when the market opens, you can think of it just like you think of liquidity map, right? You open above hedge pressure, both of them, it's a long on the liquidity map. Any one of these hedge pressures inside of here is above this, including when they're equal and you're above, that's an up. That's a long up. So you're estimating at this point in time what tomorrow's liquidity map might be a long up in the overnight. And as you see, as it being a long up, it just has that tend to push higher that most long ups do. Right? And that's kind of the inference that you make. Long ups push higher. Long ups push higher. You see that? So if I can determine that it's an LU, it's going to want to push higher and it's going to want to push higher. In general, while there may not be a pivot today to trade, there are definitely a ton of pivots. Now you see in the overnight, where does it go to and what do you trade to? I would have made no trades because it didn't bounce off of any of these at all. As a matter of fact, I was long. I bought NASDAQ futures or whatever I did, ES futures at the end of the day, and then I cashed out like right when Globex opened sometime over here. That's why you see I was in it. I made like 150 bucks, but I just got out of the trade because when I did the dynamics, it didn't look good. It could fall over there. It's like, fuck it, let me just take some profit. For a futures play overnight, you're going to pivot it. So let's go back in time and let's find some ones that actually did pivot, because you trade the pivots, and it's very, that's how I do it. I mean, you could trade it however you want. So yesterday was 38.62 and 39.07. Perfect. So I'm gonna look at yesterday's data and copy and translate this over there. Yesterday was 39.07. $38.62. Big wide range, and you expect that going to FOMC. 38.47. So class, let's do the estimate real quick before we try to do the pivots, right? We open in the middle. It's neither a long, neither a short. It could be either. So, but both of these are above here, so it's certainly an up. So you have either a long up or a short up, right? So when I look at it like that, I can say, well, long ups go up, short ups go up, with the exception of this one as it bumps against hedge pressure and comes down. So this one, as it bumps against hedge pressure and comes down, will look at there. There's your short. See that? All these starting to make sense. So it's neither long up nor short up. It's kind of both. So in the middle, what I do is I typically short from here to here or long from here to here and play that range overnight. So if you were long whatever and it obviously hits this little range right here, I would get out. And you can see that there just seems to be a lot of selling that pops up at this hedge pressure. What's really neat about the overnights is you can really see those volume spikes, right? And again, all of our stuff is predicting volume. You can see that when you get to those levels, there's abnormal volume as you're approaching that dynamic hedge pressure, even as an estimate, right? You can't not say that that's not super cool, right? Look at that. You're touching that. Look at all this randomly in the middle of the night. Now, of course, European markets are opening here, but you can see that when you hit that, the biggest candles are coming off of that dynamic, right? So I would long to the edge and get out, things like that. Where would my stop be? Which direction, long or short? My stop is always going to be, for the S&P, 10 points on the other side of either line. One strike distance on SPY, which is a point. So typically things that are $100 or more trading, so like SPY is 100, 300, 400 range, NASDAQ 200, 300 range. It's 1 point a piece. Some of the if there are, you keep telling me one sec. New version of Camera Hub. I don't want the new camera hub. I have to redo my camera settings. I don't do a lot of overnight trading unless I am hedging. I used to, and I realized that it's just over trading because, you know, you really can just do all the trading you need to do early in the morning. Right, and not have to commit 16 hours of your night, and have your family time, your friends time. It's a time to reset. I don't personally do it, but it's really lucrative if you can read it this way, because these pivots are razor sharp, and it just kind of, let's go the day before. 39.15, 38.85. 39.15 is right here. Get that, 38.85 is here. This is previous. I'm getting right from the Discord bot. Yeah, the dynamic hedge pusher is one of our better tools. And it's one of the best tools for futures traders, because in the overnight, it allows you to see, like, it's the minute the futures market opens, you can say, oh, man, I'm kind of in a shitty position for tomorrow. 38.44. No, I'm sorry. 39.20. So look at this one, right? It is neither long, neither short, but it's down, right? So it's a LD or an SD. Further note, pivot there, right? I mean, it's clear as day. All right, so LDSD, I know, I mean, it's like, I know you guys are smiling. You'll see we come up with some really cool stuff here. The trade plan liquidity map on that guy, LDSD is both of them. SD, ugh. LD, ugh. SD, ugh. LD, maybe, right? So in general, it does not want to move until you break through monthly hedge. So in that setup, again, in the middle, it only is a breakout if I break through there. Hold on, I'll be back. 1 second. Coming by, dropping flyers on my door here. So you see that in this setup, I'm not bullish until we're breaking through monthly, because none of the LD or SD are bullish, right? With the exception of the break from here or the bounce from hedge pressure to monthly, which I don't take scalps like that overnight. So most of the SD is rejection, right? LD, rejection, SD, rejection. So rejection. Again, I don't buy the dip for a rally because it's in that orientation. Does that make sense? It's really cool. Like dynamic, if you guys understand how powerful this was, and you can see that that assessment is really good. I have to finally, you know, we have videos on this, but you guys are welcome to it. The Discord bot is part of the membership. You get these numbers. I mean, I'm a futures trader. I designed it for being able to do stuff overnight, or to hedge positions overnight. Let's go back one more day. Let's do one more. I want to see what like a long pivot will look like. So the previous day, I'm just pulling these straight from the bot in the Discord. The history of them is there. 37.54, 38.09. $37.54 here. And dynamic. So you see how the assessment is to look for long ups, down ups. That's basically the trick to it. 37.94, and we teach you guys this as part of the program as well. So this is a fun one, right? So how would you guys analyze this? Let me give you guys a trick. This is a tricky one. How would you analyze this via playbook? I'll give you a chance to do it. If I was trying ES or SPX, it'd be 100 points. On the S&P is 10. On ES and SPX is 10 points. That's how much my stop is, 10 points. I give myself one strike distance overshoot of the individual options. For SPY is what my gauge is for the S&P. 1 point on SPY. Okay. Let's see if you guys can guess. Is this long up, short down, what? It's a little tricky, right? Someone take a stab at it. First of all, we know it's long this way. We know it's short this way. That's the easier way to do it. What about the middle? Well, inside of here, it's, right? If price was anywhere inside of here, it could be a short up or long up. It can be both. If it's down here, it could be a long up or long down or short down. It's all of them. So now all of them apply, right? It's the trick. They all apply. Market can go up, market can go down. Yeah. Nothing in the middle. You will see that hedge pressure pivots to hedge pressure just like you see here. But as far as picking a stance, oh wait, oh no, that's doing the wrong thing. How do I redo? Oh, there we go. I wanted to get rid of the drawing. There we go. Okay. So in this sense, you'll see that the market has that pivoting action between the hedge pressures. If it was here to there, it's all random, right? So essentially this box is considered random. So nothing actionable today. It's too wide of a range to trade, so it wouldn't be tradable, but you see here, shorting from here to here, from exactly there to there is a good range. Shorting from here to there, or vice versa, also pretty good. But you notice that you're gonna have hedge pressure monthly in the middle of that, right? Yeah, so almost like a mean reversion, right? And you'll notice that it's very much like all things apply. Yeah, great answer. I would say mean reversion is the best way to think about it. The market is opening literally in kind of the middle of this range, right? Wants to go nowhere. And that's easily seen as well. So you're opening in between the bands of monthly in the middle. Just think of it as a giant sandwich trade that's going to go nowhere. Go back one more day and do it. Yeah, these are fun. I love doing these. 38.41, 38.51. Oh, Dynamics is a really cool tool. Not gonna lie. It's great for futures traders, good for overnight traders. Absolutely. Just for the reason of you can have, I mean, you don't have anything else to go by, right? It's really hard to determine, and most of the overnight action is just, you know, slight hedging a little bit. So this guy right here is long up, no matter what you do. Stock market open inside of this range. It's clearly a actionable pivot off of here. So pretend that the market opened just like this, right? You know, it's a long up. Trading from here to there. I got here, take the long, stop 10 points below 50. So if it goes back to 41, I would stop the trade. So if I chase the long on this one, I would stop. If I chase the long, I'd stop 10 points below in the overnight. Now, these things go away when the morning session starts, but long up, we can show you what long up looks like again. Long up. Bullish, bullish. So long up has that desire to push higher until it hits another catalyst, right? So overnight, the long up, it just pushed higher and pushed higher and pushed higher almost for the majority of the night. Then European markets opened and the new catalyst came through and it started trading down. And so had I bought here at 41 and sold there, I wouldn't take a 10-point scalp. But had I chased that long at 51, I would have stopped at 41. Which is, right, better safe than sorry. But you know that volatility came out. But then the stock market opened and then you do whatever the new thing is. But because it's long up, you can see the majority of the market until it reaches another catalyst. European markets open, it just drifts up. So you expect long ups to drift up. So, you know, liquidity map tends to be where all things flow when there's no counter catalyst, which is why in our rules, it says you can't have a rational market and still do the liquidity maps. Because in the trading strats, you'll see right here, any kind of catalyst or individual catalyst or anything can jolt things the other way. So liquidity map is how the market flows when there's no catalyst. Let's do one more. Just like that. Pretty cool, right? If you guys don't mind clicking that like button on the stream, we love you guys. Help us grow, help us go. Any like since hosting anything today? This is fun. Oh, you are a member. Yeah. I figured you were. Couple more. What was that one at 51, 41? Okay, one more. 41 and 21 previous day. And a lot of times, a lot of the stuff that we have, it's open to exploration. When we invent something and you guys find new ways to use it. And one of the things, you know, don't just assume that we just invent something and then know how it works. We invent something and we think we know how it works, and then you guys come up with better ways to use it. And the interesting thing is that what can we learn? You know, ideally, the dynamic I was using to just place options to get out of my trades. When somebody says, why don't you do monthly dynamic? I said, okay. They said, why don't you estimate if you think it's a long up or not based on the monthly dynamic and see if it works. And then we tested that out and it actually worked. So then we have a technique that came from member driven. This particular setup, you are both long up and short up, because all of these are above here. Long up bull, long up bull, short up bull, and short up. Ugh. So again, I'm only bearish if we lose monthly hedge pressure, and I'm only bearish if we lose monthly hedge pressure, and it went up for the day. Pretty cool, right? So clearly I would chase a short if that happened. Here I would chase a short if that happened. Does that make sense? Here I chase a long if that happened and jump in. Here it's long up and short up. Again, I would chase shorts. Again, most of it's like if you lose monthly in that same sense. One thing that another members have noticed is that the dynamics on the previous day have influence even on the current day, since they do create volume activity and hedging around those levels. As in, at the end of the day, I use dynamic to place options at the end of the day. I'm sure market makers and others do the same things, which is why they pivot. Even when the stock market opens, what our members started noticing is that, and this is a study, if you guys didn't know, if you're members in our Discord, I'm gonna show you something cool. Okay. In our Discord, you may not notice this, but you see all these things that say project. Members, or thousands of members, volunteer to come through and be part of different processes. There currently is a project right now going on to study that effect. There's all kind of discussions going on in every one of these project rooms. So members just volunteer to be part of the process. It's a really cool thing. And when you get that Club Rocket designation, like an honorary title, the Club Rocket was given to people who helped build something in this community. And so if you made something, build something, you contributed something, we actually give you that little title. And yeah. So going to these things right here, I'm going to show you that even overnight, you interact with these levels in the daytime, they'll create volume. Here, even after market opens, people were noticing like 38.40. Look at this day. People noticed this a long time ago, is that 38.40 is a launch point, and look at all that volume at 9 o'clock, right? There might obviously a catalyst there, but you can see that 38.40 is a pivot with volume. And so the overnights actually are they possibly volume pivots in the daytime too? And is that a new rule that we haven't discovered yet? So that's kind of the forefront of our possible 15th indicator. The dynamics could actually be used in the daytime session as well. Previous night, 38.51. Your market opens, is 38.51 causing any volume, right? Any volume pressure. And the answer is yes. We're seeing it. We're seeing a lot of it. As a matter of fact, there's a volume spike right here as you're approaching 38.51. Right. So, and then of course you get these launch points from here, high volume here. So why? And the interesting thing is we don't know why. So the study is not to prove that that works. It works. It's definitely working. But we need to explain the phenomenon we're experiencing it other than, hey guys, there's just a pivot that works, right? So the study right now is to dive in and this is really hard one to solve because the mechanics of what causes this requires me to estimate the open interest at the end of the day before Opera reveals it overnight. I have an estimation, a real-time open interest model that takes, nobody has this. You had to build it from scratch. And the only thing that makes sense now is at the end of the day, everyone, including hedge funds and institutions and market makers, are in the dark. Opera releases the options data to everybody at the same time. So at the end of the day, is it that market makers and hedge funds themselves also have a dynamic open interest model, a real-time open interest model? And is theirs similar to mine? Did we all stumble onto the same conclusion? Therefore, we all started buying options at these levels at the very end of the day. And it creates that options effect because options are going to expire throughout the next day. Therefore, they're going to be hedged throughout the next day at those levels. Meaning that is my estimate the best you can do? And have other people stumbled onto the same estimate? That's the question. Pretty neat, right? And I guess that is Doomsday because you guys were asking about it. What was the screen number here? And it looks like he did put the Doomsday number into the Classic app. Very neat. So that would be the answer is why do these things have volume pivots in the next day? And we don't know. But the answer is I've stumbled onto the same conclusion that the market makers and hedge funds have, and that everybody essentially does real-time open interest the same way. And it's plausible because my real-time open interest model, while it's very complex, the math is what makes it complex. The theory is very solid. If you understand options, you'll know how to do it very accurately. I think everybody just does it the same way, which creates that activity. So here you can see 38.85 is also pivoting with volume. It's very interesting to see that. And again, is it because at this particular day, somebody's long the market and they would do what I do? They'd buy puts right here, and the person that sold the puts right there are going to long that area to keep it from going in the money, and they're going to long that area to keep it from going in the money. And that's the theory, and the theory is, can we prove that that's the case? So in Rocket Scooter, like you say, we spend a lot of time proving things. The observation is absolutely there, but we're not going to make it a rule or trading rule yet until we understand why it's happening, other than just happens. Statistically, it happens a lot. Anytime you tap to those levels, again, there's volume support here. It's neat to see it. And the observation was made by one of the members who's now spearheading that project. Yeah, here, exact perfect balances during the equity session. Right on point. These little V's right here. And even today, right? 48 and 44. There's 48. There's 44. If monthly's in the middle, it's mean reversion. If monthly's on the outer side, breaking monthly is a chase. If monthly's on the outer side and you open between the hedge pressures, scalping between them is what I do. If you are above both high hedge pressures or below both low ones, I trade against it in that same direction. If it's long up or short down. And then I will end my trade at monthly because it'll pivot. It's just a straight up, yeah, we can do a whole lesson on it if you guys want. Any thoughts on 0 day to expiration options SPX, which are now 40% daily volume, and how much it impacts such pressure during sessions compared to when these options volume are not that significant? You're talking about today's session? Hedge pressure is calculated on SPY. So as far as the impact of SPX options on hedge pressure on SPY, not really connected, just loosely connected, right? Because SPY is chasing the SPX. When the market's less liquid or less volume is being traded, or just slower market, I would say that the impact on hedge pressure, it's hard to say, because it's going to be based on values of those options, whether it's less or more liquid, or less or more volume. It's going to be hard to say that impact on the value could be, because I know, I think you're referring to that study that people published, right? There's a published study this week. Oh no, not this week, but I remember maybe it was Bar Chart that posted it, that talked about the majority of trading throughout the day are these 0-day options, right? A lot of the pressure that's caused intraday is 0-day options, 0-day expiration. So are you saying that impact become that's a more popular trade by these large institutions? Is that having a bigger impact on hedge pressure? I would think the impact it would have would be on changing hedge pressure. Like for instance, today, if people are really just diving into today's options, hedge pressure today could fly all over the place, right? It's very possible. What time frame do you trade overnight? I don't understand what you mean. What time frame? Like what time frame do I use on my charts? Do you ever understand that the basic understanding of what we do at Rocket Scooter, there's no time frame. There's no confluence. You can get rid of that forever. You never have to put confluence on a chart, hourly chart, 5-minute chart. Time frame is, I want my trades to not take 16 hours. I want to get in and get out within a couple hours. And that's why I don't do much overnight trading anymore, because instead I like to go have my life. I go to the gym, things like that. So overnight trading, you're committed, from like 5 p.m. or I'm Central Time, 5 p.m. until like midnight or later. And it's just like, if you're married or you have friends or you have, kids or whatever, you don't want to be spending your family time like staring at your phone like every 10 minutes like this. Everybody's gonna start hating you at that point. So if you say what time frame is that, whatever, I always have a 1-minute chart and maybe a 5-minute on a slower night. Like all I want to do is see all the day's information on a chart. The time that you pick is arbitrary. Technical analysis gurus and coaches and technical analysis algorithm sellers, right? People package up a bunch of TA indicators and mislabel it as an algorithm and sell it to you. Their scam is to tell you to use multiple time frames because that's filling in the holes. Well, the algorithm doesn't work on the 1 minute, but maybe if you put the 5-minute and the 8-minute and the 20-minute and the hour and the day and the week together and look at all these different options, and maybe it'll give you an answer. I think confluence on multi-time frames is like the biggest scam out there. It's not going to change. You can choose any time frame you want and reconfigure how you see the chart. Oh, it's bullish on the 5-minute? Cool. Oh, it's bearish on the 30-minute. Ugh. Engulfing candle on the 30. Bullish on the 1 hour. Bearish on the 33-minute candle, like bullish on the 22-minute candle. Like, I mean, you give yourself flexibility. All you're going to do is curve fit and see what you want to see, right? You're going to focus on the one that agrees with the position you want anyways, which is very dangerous for new traders. And I know every once in a while there's a sucker that buys into that whole idea. But technical analysis and those book sellers and algorithm sellers tend to be very heavily leaning on something called confluence, which is like, well, it doesn't really work, but you can add different time frames and maybe make it work, and add more time frames and add more time frames. Eventually, you have enough time frames that agree. It's like infinite complexity with infinite degrees of freedom to give the user, all the options in the world to change to whatever they want. So learning like what time frame you trade on, start to remember that time frames don't matter. There's no such thing as a good time frame. You just want to see the information that you need, right? The information I need is I want to see volume at that level. I don't care about how much time it takes. I'll zoom in as far as I can. If we're really far away, I just want to see all the data really quickly on a chart. A 5-minute chart is the way I can see like 2 days at once. A 1-minute chart is the smallest granularity I can get when we're at that level. Then I'm going to put on that 1-minute chart. In reality, if you want to go even in time dependent, you can stick charts, right? But tick charts will lock in the volume bars to number of ticks, which typically won't. We'll lock in the candles to number of ticks. So typically, you're not going to see volume that easily over time. And seeing the volume is much easily seen on a time chart. So those volume spikes, you'll see them like on the smallest chart you can get. 1 minute's enough for pretty much everything to see. So I always have the 1 minute chart open. If it's nighttime, maybe the 5 minute, just because the things are moving so slow. Right? But time means absolutely nothing. Choosing how you display this data with the freedom for you to choose. Just imagine, right? It's like I said last night, I was on the Trading Camp podcast. It's gonna publish tonight, by the way. I was interviewed on a podcast with a bunch of really cool dudes. If you guys don't know them, they're really awesome. They have a trade group as well. AJ was on there one time, started talking about Rocket Scooter and what we did. And, you know, a lot of you guys came from that when y'all heard it. So they reached out and were like, hey, you know, we'd like to pull you onto the podcast. So last night I chatted for an hour, talked about all kind of stuff. I plan on dealing with Forex. Eventually it's possible. No plans currently to do it though. So I talked about all this stuff there. And I basically talked about how, you know, new traders get trapped into complex things that seem easy on the surface. I believe if you want to learn technical analysis and start studying charting and charting history, that's actually more advanced than you think. You think you pick up a chart and start like looking at averages and that's going to help you make trading decisions. The reality is those indicators are always delayed, they're always inaccurate, and they don't turn themselves off when markets have catalysts. They tend to still believe that the market's active and trading like it's ebbing and flowing when in a nutshell, it jumped hundreds of points on a catalyst. Your averages are too slow to catch up to that. Your MACD is going to fail. And people will take those types of indicators and rename them, relabel them, recolor them. You know, MACDD, MAC, you know, QRSTUV, whatever. People come up with names for these different things just to really try to sell it in a different way. But it's the same problem. You have to estimate when you think something's going to cross over and then get in before it crosses over and then hope it crosses over to give you the signal after you're in the trade. Well, you don't need the indicator to even take a guess. You can guess on anything, which is essentially what you're doing to make it work, is guessing anyways. Once the indicator's crossed over, you're too late to the trade almost every time. So people get into technical analysis because they're sold a chart, or their pictures are posted in Discord or posted on Twitter after the fact of, look where you could have bought here, and this was the signal. And like, no, that's not exactly right at all. It's actually a bold-faced lie. If I have a 10-period moving average, it's just mathematics. So a 10-period moving average from this point, right? It means it's my line at this point is based on 10 candles in the past. Okay. So while 9 of them are anchored, 1 of them is moving, and therefore the tail of the SIG is going to move up and down in real time. They only, when you see at the end of the day a chart that looks like that, it only looks like that from the future looking back. In real time, these guys may have crossed over here in real time as the market had a big candle and then sold off, and then went like this, and it might have crossed and uncrossed and crossed and uncrossed and crossed and uncrossed. And then finally over time, you need at least, if it's 10 periods, you need at least 10 periods for that cross to anchor in. So the fundamental flaw is that the entirety of the periods are moving around. Because if you're looking 10 points in the past, then it takes the 11th candle for the first one to literally anchor this. Now, the variability is that, 10 candles ago, it just might move like that, move like that, move like that. A little bit bigger each time. But you're going to see a lot of variability in your averages anyways, which means what it looks like at the end of the day is not a screenshot of what happened in real time. In real time, it's confusing as fuck. Right? Imagine that your averages are like this, are right on the cusp. You have a candle, and the candle goes up a little bit. So look at that. There's your buy signal. And the candle goes down in that minute. Oh, nope, there's your sell signal. Candle goes up. Nope, there's your buy signal. Candle goes down. Oh, there's your sell signal. In the minute, it's like ding, 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 ding. Buy signal, sell signal, buy signal, sell signal. And then maybe out of the course of the day, we trade it up, right? but it went down for 2 or 3 minutes before it came up. So at this point in time is when that battle took place. You got all the signals, but when you come back later and into the day, you'll notice the crossover actually is shown right there. And that's the scam that they cover up by trying to tell you use Confluence. Is that when they show you the chart after the fact, it's never where that crossover really was when it happened, because that's just how averages work, right? It's like easy to see that. But in reality, I love when people talk about time frames, because there's a lot of misconstrued information when you're looking at time and averages. And when a new person jumps in, they don't understand these things. They don't know those complexities. The guru says, look at that signal, bro. And there's that dip, and then the market ripped, and look at that, right? The crossover, you would have got in there. No, because your brain was trying to get in here when it was battling, and then you probably got in and stopped out, and then that happened in reality. So in reality, it's never what you see in the past. You're not taking a snapshot of the sum of every moment by looking at a chart with indicators on it. You're actually taking a snapshot of the result of every point, at least those many periods in the future. So each point on the chart is a picture of that indicator needing at least 10 or 15 or 50 or however many periods in the future to anchor it in place. So in reality, you can't use them in real time. So you're forced to, as they're coming to crossover, to guess that 10 periods in the future that crossover takes place. So essentially you're just guessing. But you're not teaching people, they're not teaching people this complicated process of guessing. You're just saying buy when the things cross over and everyone's late to the trade. And so options are the same thing. It's like people just YOLO 1500%, whatever options. But the problem is new traders get in, they don't understand Greeks, they don't understand that options aren't just picking a price and time to trade to, like I want to trade to that strike, but it's not longing the call to get there. It's I have to pick a strike at a point in time and guess how it gets there. Does it get there like that? Does it get there like that? Okay. Picking the right price at the right point in time and the trajectory of how it gets there are all required to profit in options. Okay. Where most of you and all of us, none of us can, actually, to be honest, none of us can predict that. Which direction, how can predict a stock market and then predict when it happens and how it gets there is what you need required to trade options, which makes it the most complex thing you can trade. If the option, if the stock goes right to there in the first day on a weekly expiring option, the stock does this and this and this and this and this and gets there on the last day, value is going to be much different, even though you picked the right trajectory, or say the right location and the right time. How it got there, they're going to have different values. Okay. So traders get trapped into complex things that are sold to them as being easy. The Rocket Scooter, our goal is to try to not mask the complexity of things and really show you the realities of it. Options are a trap to new traders. Technical analysis is a trap to new traders. The complexity of the limitations of technical analysis need to be at the forefront of your brain as you're using it. It's as hard as options because you're making a prediction at a point in the future of something happening and how we get there. I mean, you're doing all kind of additional stuff. So at least the Rocket Scooter, the difference is we're trying to predict pivots at a price time independent. So there's no predicting when it happens and there's no time frames that matter. That's the difference. Slippage a huge deal in futures? Depends on which futures you're trading. Most of them, not really. These days, a lot of them are very liquid. The spreads are, even overnight, very, very low in most things. But some of the very obscure commodities contracts that aren't really traded a lot may have some slippage. But as far as generically defined as slippage, when you are market order or market order buy, market order sell, that the bid or ask will move to fill your price, you don't see that really at all. And I don't define that as slippage. I mean, I define that as slippage, not high bid ask. So for instance, if the NASDAQ has 5 ticks between the bid and ask, you market order, you're not going to get 6, 7, and 8 on your trade usually unless you're buying 20, 30 contracts. So manageably as a day trader with 1 or 2 contracts, you don't experience a lot of slippage. You might experience a little bit of illiquidity and like fills at the ask or fills at the bid on market orders, but they're liquid enough and robotic controlled that unless you go in with the big order, they're not going to drop the bid 3 or 4 points or ticks to fill you, which is what the definition of slippage is. So you should be cool. The answer is no. You're not going to experience a lot of slippage. You'll use limit orders. You don't have slippage, period. But if you use market orders, typically you're filled at the bid and filled at the ask every time. Everything I've ever traded, which is oil, gas, treasury futures, commodities, gold, metals, popular stuff. I've never traded like wheat or lean hogs or orange juice or anything like that. So I'm not really sure if those experience that. They're all on different exchanges for the most part, but the CME group and the Globex controls all of them anyways, with the same mechanical computer system that manages the market. So I'd assume that it's similar across the board. But the less traded something is, the less liquid it is, the higher probability there would be slippage. I haven't really experienced much. If you're talking about trading like ES, absolutely not. ES is liquid 24/7, even the overnight. There's a 1-tick bid-ask spread. I never see it not that. Unless there's a catalyst, maybe the spread gets bigger. That ES is razor sharp. It's tight. It's super tight. Yeah, exactly close. Generally 1 tick away at all times. I've never seen it spread out in normal markets. Maybe a catalyst comes out, it might widen quickly, but there's always just that. It's really tight. It's on the magnitude of, you're 12.50 a contract, so even a couple ticks, you're losing 15, 20 bucks. Your slippage is not 5% or 10%. Okay. Like trying to buy options on a penny stock. You're gonna get fucked. Isn't that right? Yeah, absolutely, no problem. All right, guys, Rocket Scooter free trial. Go there. We're going to take a 2-hour break. Come back for FOMC. We'll be live maybe 30 minutes before it starts. I need to get out of here and call it a day. We love you guys. Come back later. We'll see y'all tomorrow. Or see y'all near FOMC. We'll come back. Go to rocketscooter.com right now. Get that free trial. Everybody. No credit card required. Just type it in. Go there. Visit that website. Get the free trial and go sign up for the Discord, and we will see you guys in 2 hours, and I will show you my tricks on how I trade FOMC. We'll see y'all later.